Welcome to the Deep Dive. If you've been keeping an eye on the electric vehicle market, well, you know it's been quite a ride lately. We all remember that incredible boom in EV stocks back in 2021. It felt like everything electric was just shooting for the moon. But in the years since then, a lot of that initial excitement seems to have, well, sort of fizzled out.
Right, fizzled is a good word for it. We've seen a lot of pressure.
Yeah, definitely. Things like rising interest rates making money more expensive. Pretty fierce price wars breaking out.
Those stubborn supply chain issues haven't gone away entirely either.
And general inflation, plus, the whole situation with higher tariffs and these intensifying trade disputes. It adds up.
It really does. And looking at all that, you might think the EV story's kind of stalled.
Exactly. But that's the core idea we want to dig into today in this deep dive. Despite these very real short-term challenges, there might still be some really promising opportunities, especially in what's become a bit of an out-of-favor sector.
Finding value where others might be overlooking it.
Precisely. We're basing this on an interesting article from The Motley Fool, published just now, July 13th, 2025. It's titled, "The Smartest EV Stocks to Buy with $500 Right Now."
Okay.
So, our mission today is to unpack the thinking behind three specific EV-related companies mentioned in the piece. The idea presented is that these could potentially turn, say, a modest $500 investment into maybe a few $1,000s in just a few years.
Ambitious, but potentially rewarding if the analysis holds up.
Right. Think of it as looking at different layers. The vehicles, the charging infrastructure, and then the underlying tech. So let's start with the vehicles themselves. Lay out the landscape for us on the first company, NIO.
Okay, NIO. What's interesting, as the article points out, isn't just that they make EVs, but how they differentiate. They're a major producer in China sedans, SUVs, and they operate with 3 brands now. There's the main NIO brand, that's for their higher-end vehicle.
The premium stuff.
Exactly. Then they've got Onvo, aimed at cheaper SUVs, and Firefly, which is for smaller, compact EVs.
Okay, covering different market segments there.
Right. But the real kicker, their key innovation, is the swappable battery system.
Oh, yes. The battery swapping. Tell us more about that.
So instead of plugging in and waiting, NIO owners can just drive into one of their battery stations and swap a depleted battery for a fully charged one.
How quick is that?
They claim it's much faster than typical charging. It's positioned as a major convenience factor, closer to a gasoline fill-up experience.
Interesting. And how has NIO performed? Let's look at their growth.
Well, if you look at the period from 2019 to 2024, the growth was frankly huge. Deliveries shot up almost 11 times, from about 20,500 vehicles to nearly 222,000.
Oh, that's significant scaling.
And importantly, their vehicle margin improved dramatically, too. It went from negative territory, minus 9.9%, all the way up to positive 12.3%.
That's a big turnaround on profitability per vehicle.
It absolutely is.
Yeah.
And it resulted in a revenue compound annual growth rate, that's CAGR, of 53% during that time.
53% CAGR, okay.
Yeah.
What drove that?
Several things. Strong sales of those higher-end models, for one. Plus, they really pushed the expansion of their battery swapping network and their battery-as-a-service subscriptions, the BaaS model.
Right, the subscription model for the battery itself.
Exactly. And they also started shipping more vehicles into Europe. We should also mention Chinese government subsidies were pretty critical, especially back in early 2020 when they faced a serious credit crunch.
Okay, so a mix of factors fueling that growth.
Yeah.
What about looking forward? What do analysts expect?
Analysts are projecting continued revenue growth, though maybe not quite at that 53% pace. They see a CAGR of about 26% from 2024 through 2027.
Still very solid growth.
Yes. And they also anticipate NIO's adjusted EBITDA, that's earnings before interest, taxes, depreciation, and amortization, turning positive in 2027.
And what's the thinking behind that expected profitability shift?
It's expected to come from selling more of those premium, higher-margin vehicles, getting more revenue from the battery subscriptions, and just generally tightening up their spending, streamlining things.
Makes sense. Now let's talk valuation. Where does NIO stand now, according to the source? This is as of July 11th, 2025.
Right. As of that date, the market cap was around $8 billion. The stock price was $3.90.
Okay. And how does that translate in terms of valuation metrics?
It's valued at just 0.6 times this year's expected sales, which is, well, quite low.
But 0.6 times sales seems very compressed. Why so low?
The article points squarely at the ongoing trade tensions and tariffs. That uncertainty really weighs on investor sentiment, especially for companies so heavily focused on China and expanding globally.
So the argument is that the current price doesn't reflect the underlying business potential.
That's the core insight, yes. The idea is that this compression creates an opportunity. If there's any hint of improvement, maybe a trade deal or just milder economic headwinds, less intense competition, the valuation could potentially, jump significantly.
That battery swap strategy for NIO really stands out. Is it truly unique on a global scale? I mean, how much of a competitive advantage is that, especially with that valuation pressure you mentioned?
It's certainly unique at their scale. Others have maybe dabbled, but NIO's built a real network around it in China.
And does it change the ownership experience fundamentally?
I think that's the argument. It offers convenience, like you said, maybe rivaling gas fill-ups. But also, think longer term. The potential to easily upgrade batteries as tech improves, or replace aging ones. That could tackle battery degradation anxiety and maybe even extend the car's useful life.
That could be a game changer in how people think about buying and owning an EV long term.
Potentially, yes. It addresses a key pain point.
Okay, so NIO's innovating on the car and the refueling, but whether it's swapping or plugging in, reliable charging access is absolutely critical for any EV. Let's shift focus to that infrastructure piece. What about the public charging network, particularly in the US?
Right, you need places to charge or swap. That brings us neatly to the second company highlighted, EVgo. They're described as a leading builder of EV charging stations here in the States.
EVgo. Okay, what's their scale like?
As of the end of Q1 2025, they had 4,240 charging stalls operating, and they were serving about 1.4 million customers.
1.4 million customers. Wow. How do drivers pay?
They offer flexibility. You can just pay as you go for each charge or sign up for a subscription plan. Those start around $6.99 a month and give you discounted charging rates.
Got it. And have they been growing that network rapidly?
Oh, yeah. Since the end of 2022, the number of their charging stations jumped by over 50%.
50% increase in stations.
And their customer base grew even faster, up over 150%.
So more stations and many more users for each station.
Exactly. And that flowed through to the top line. Their revenue grew at a CAGR of 117% from 2022 to 2024.
Whoa, 117% revenue CAGR. That's explosive growth. What's behind that?
It's a combination of things. They made an acquisition, Recargo, back around their SPAC merger in 2021. That helped. But also, key partnerships have been crucial. They've teamed up with big names like General Motors.
Okay, the automakers.
Berkshire Hathaway's Pilot Flying J truck stops.
Travel centers make sense.
And even Chevron. So tapping into existing infrastructure and customer bases.
Smart strategy.
And crucially, they've benefited a lot from government incentives, both federal and state, aimed specifically at encouraging the build-out of charging stations. That helps de-risk the investment.
Right. Those public funds are important for scaling this kind of infrastructure. What's the outlook for EVgo then?
Analysts are forecasting continued strong growth, projecting revenue to increase at a 32% CAGR between 2024 and 2027.
Still strong, though moderating from that 117%.
Naturally, as the base gets bigger. But significantly, they expect adjusted EBITDA to turn positive this year in 2024 and then keep climbing through 2027. That's driven by economies of scale. As the network gets bigger and more cars use it, each station becomes more profitable.
Profitability insight this year.
Okay.
And valuation as of July 11th again.
Market cap was about $463 million. Stock price at $3.44. That puts its valuation at about 1.3 times this year's sales.
1.3 times sales. So higher than NIO's multiple, but still seems relatively low for that kind of growth, perhaps.
Well, the thinking is that the current, let's call it softness in the overall U.S. EV market is likely keeping that valuation down. People might be hesitant about the pace of EV adoption right now.
But the argument is the long-term need is undeniable.
Exactly. The need for charging infrastructure isn't going away, even if EV sales fluctuate month to month. So once the broader economic picture brightens, the potential for a much higher valuation is definitely there.
Those partnerships. EVgo has GM, Pilot Flying J, Chevron. They seem really strategic for getting stations built quickly. But does relying on partners create any risks, like dependencies or, power balances?
That's a really good point. Partnerships are great for speed and scale, but yeah, you do become somewhat reliant on your partner's strategy, their locations, their capital sometimes.
So how does EVgo manage that?
It seems like they try to mitigate it by diversifying. They aren't tied to just one type of partner. They've got automotive, travel centers, traditional fuel retailers. That spreads the risk.
Okay, diversification helps. And you mentioned the softness in the U.S. EV market. What specific hurdles does that create for EVgo right now? Competition, keeping those stations busy.
The main challenge in a slower market is utilization rates. You build a station, you want cars charging there as much as possible to get a return on that investment. If EV adoption slows down temporarily, it might take longer to reach profitable utilization levels.
Right.
But again, that's where those government incentives come in. They help buffer that risk, ensuring the build-out continues because everyone recognizes the long-term strategic need for the infrastructure, regardless of short-term market dips.
Okay, that makes sense. So we've looked at NIO's cars and battery tech, EVgo's charging stations. Let's peel back another layer, go even deeper, maybe to the components, the foundational tech that makes all this work. What's the really enabling technology here that maybe flies under the radar?
Now we get to the really interesting stuff, perhaps. The third company is Navitas Semiconductor.
Navitas Semiconductor. Okay, what do they do?
They're described as a leading producer of specialized chips. Gallium nitride, that's GaN and silicon carbide, or SiC chips.
GaN and SiC. Why are those special? How are they different from regular silicon chips?
Well, they have significant advantages for power electronics. They can handle higher voltages, they can switch power on and off much faster, and they can operate efficiently at higher temperatures compared to traditional silicon.
Okay, so more robust, more efficient for handling electricity.
Exactly, which is crucial in the EV world. Their GaN integrated circuits, the ICs, are used a lot in EV chargers, making them smaller and more efficient. And they also make SiC devices that go into the EV platforms themselves, like in the powertrain.
So they're in the chargers in the cars.
Right. But it's not just EVs, this is important. They also sell these chips for things like laptop power adapters, those small, fast chargers, often GaN inside, also data center power supplies, solar inverters, industrial motors, energy storage.
Okay, so they have a much broader application base than just EVs. Diversified.
Very diversified, which means they aren't solely dependent on the ups and downs of the EV market cycle. That provides some resilience.
Smart. How has Navitas performed, growth-wise?
Pretty impressively. From 2020 to 2024, their revenue grew at a CAGR of 62%.
62%. Another high growth story.
Yes. And their adjusted gross margin expanded too, from 33% up to 42%.
Improving profitability alongside that growth.
And what's really notable, the article points out, is they achieve this even while the EV market plus the solar and industrial markets they serve were facing some pretty tough macroeconomic headwinds during parts of that period.
So that suggests strong underlying demand for their specific technology, regardless of the broader market conditions.
That's the implication. It points to the disruptive power of GaN and SiC technology itself.
What's the outlook for Navitas going forward?
Analysts are predicting continued growth, projecting a revenue CAGR of 17% from 2024 through 2027.
Okay, moderating growth again, but still solid. And profitability.
They expect adjusted EBITDA to turn positive by 2027.
And what are the key drivers expected to fuel that continued growth and path to profitability?
The article highlights a few things. A new deal related to AI data centers with Nvidia is mentioned.
Oh, interesting. The AI angle.
Yeah. Also, the broader adoption of fast chargers using GaNs in consumer electronics like laptops and phones,
Right.
and wider use of their sextate chips in EV chargers specifically.
So multiple growth vectors there. What about Navitas' valuation as of July 11th?
Market cap was around $1 billion, maybe $1.2 billion referenced in some places. Let's say around $1 billion. Stock price at $5.87.
Okay, and the sales multiple?
Now, this one looks different. It's trading at about 19 times this year's sales.
19 times. Okay, that does sound, as the article might say, a bit pricey compared to NIO's 0.6 or EVgo's 1.3.
It definitely looks richer on that metric, yeah. But the perspective offered is that you're paying for its strong position in these rapidly expanding game and sex markets. These are seen as nascent technologies praised for huge growth.
So it's less about just the EV market recovery and more about a bigger long-term tech shift.
Exactly. The insight is that Navitas is both a near-term play on EVs bouncing back and a much longer-term play on GaN and SiC high, disrupting traditional silicon chips across a whole range of industries. It's about that fundamental technological transition.
That is where it gets really captivating, isn't it?
Yeah.
Navitas gives you a totally different way to think about investing in the EV space. It's not the cars, not just the plugs on the wall, but the brains behind the power conversion.
The enabling technology.
Right. When you say it's a fundamental disruption. What's maybe the biggest thing people misunderstand about these advanced chips? How do they really change the game for EVs or even energy more broadly?
I think the biggest misconception is just seeing it as a small improvement, like a chip is a chip. But GaN and SiC aren't just slightly better silicon. They allow for fundamentally different designs in power electronics.
How so?
They let engineers make devices smaller, lighter, and crucially, much more efficient. Less energy wasted as heat. For an EV, that translates to things like lighter components, which helps range, potentially longer range from the same size battery because the power systems are more efficient, and significantly faster charging because the components can handle the power transfer better.
Smaller, lighter, faster, more efficient. Those are big deals.
Huge deals. It's about getting more performance out of less energy and less material. And that principle applies way beyond cars think, more efficient solar power conversion, smaller power bricks for everything, more efficient data centers. It cascades across the energy landscape.
Okay. So we've kind of journeyed through these 3 layers today, haven't we? All interconnected parts of the EV revolution.
We really have.
Started with NIO, the vehicle itself, that unique battery swap model, especially relevant in China.
The innovation at the car level.
Then shift into EVgo,
Yeah.
the central infrastructure, building out those charging networks needed for mass adoption, focused on the U.S. here.
The critical backbone.
And finally, we went, under the hood with Navitas Semiconductor, uncovering that cutting-edge chip technology, the GaN and SiC, that makes a whole system work better, more efficiently.
The foundational tech enabling it all. And if we sort of connect those dots back to the bigger picture, you can really see how these different areas making the cars, providing the power, and advancing the core components, they all rely on each other, don't they?
Absolutely interdependent.
The success of one area really helps fuel growth in the others. It shows how complex this whole transition is, and maybe why the simple EV story is over a narrative is, well, too simple. There are many layers still unfolding.
It's definitely far from over. So wrapping this up, what does all this mean for you, the listener, as you watch this sector changing so fast? Beyond the day-to-day market moves or the potential of these specific companies we discussed, here's something to think about. What kind of technological innovation, maybe like these advanced chips from Navitas, things you don't even see on the road, what kind of unseen tech do you think will ultimately have the biggest, most profound long-term impact on how we get around and how we use energy in the future? Something to mull over. We encourage you to keep exploring, keep asking questions, and keep digging into these fascinating topics. Until next time on The Deep Dive.